And Chris, it's my pleasure to introduce you. I don't know, we're sort of switching the convention around here, but I suspect there's quite a few people in the audience who think they know a little bit about you, and people who see you walking down the street would probably recognise you from one form of your life, but I suspect there's quite a few of them who don't realise what you do more recently. There might be a few of them who are familiar with Talk Your Book, which is a really successful online forum for people to promote their companies and ask cool questions there. But you're also a fund manager. You've done VC-style investing and now macro across the market. Pleasure to be talking to you, Chris.
Thank you, Hedley. I appreciate the kind words. I'm not sure if they're all getting true, but I've launched a small fund and very excited to get into conversation with you and speak about all things gold and essentially what comes next in an interesting market. And I thought the best way to kick it off would be around the de-dollarisation headlines which we've seen. And if anyone hasn't been living under a rock for the last 12 months, we've seen those headlines coming out of both China, but even Janet Yellen the other day said that people should expect a gradual de-dollarisation. What do you make of these headlines, and do you think they're significant or just more noise in a busy market?
I don't think they're just noise. If you look at what reserve currencies have been over long periods of time, the US dollar really came to prominence after World War II. The Americans had sold guns, ammunition, tanks to the Allied forces. In fact, they've sold, I think, ammunition, guns and tanks to many people on many sides, but in the two major world wars to the Allies. And they sold those for gold. So they backed their currency strongly with gold, and the US dollar became quite prominent as a result of that. The world's moved on quite significantly, and we're seeing China come to prominence as an enormous economic power. So I think that's probably what starts to chip away at the US dollar, is not only a strong economy, which mimics the way that the US dollar came to prominence, but it also starts to question, we'd like to be using our currency the same way that the US dollar is used. So I think that probably raises those questions, although I think the interesting part of it is Janet Yellen suggesting that de-dollarisation could be a thing as well, because that kind of acknowledges that they might want to move away from some of that prominence themselves.
Do you think that people need to differentiate the world's reserve currency versus the world's reserve asset in US treasuries? And in your opinion, what really matters? I mean, if people are trading in yuan or in yen or in whatever, and as soon as that transaction's gone through, they're then transferring that into a reserve asset. Is it really the reserve asset people should focus on as opposed to which currency the trade's going through?
Yeah, I think it definitely does. It might have mattered a little bit less in a world when you could buy an asset like a US Treasury and you needed US dollars to get to it. And I think we've moved a long way, even in a decade, in terms of how you hold stable assets and the currencies that you need to access them. So at the end of the day, yes, I think the assets are the more important thing.
And so what seemed to be really significant was in March 2022 when Russia had $300 billion of foreign exchange reserve sanctioned by the US. That for a lot of countries, a lot of people, that seemed like a potential game changer for where countries can hold their surplus assets, because most countries over a long enough time frame had a beef with the US at some stage, and if they were in a beef with the US and all of a sudden their treasuries or other foreign reserves could be sanctioned, it would make sense for countries to question how much of their surplus reserves they want to keep in US treasuries. There's been a view that the US did that unknowingly, that they weren't aware of the implications. There's also a view they knew full well what the implications of that would be, and that over time it would potentially weaken US treasuries as a reserve asset, weaken the US dollar, which would make their manufacturing more competitive due to the weaker dollar. And if they are potentially going to get into a hot war with China, it's a war they're not going to be able to win without a competitive manufacturing industry. Is that something you've thought about at all, and do you think that could have been a strategic move by the US because they do need to build out their manufacturing industry again if they are potentially getting a hot war with China down the track?
I'm not sure which part of that to answer first, but I think the concept itself, first of all, you've got the call it the anti-US bloc, which is China and Russia right at the top of it, but you've got a whole litany of countries which don't agree with the US political way of doing things. And like you say, I mean, if you had a major asset in your national treasury, which was something which the US could snap their fingers and say, you're not able to sell that, we'll talk to everybody who could buy it and we'll prevent them from being able to liquidate that from you, you're instantly insolvent. Solvency is a big issue for those countries, but can often find different ways to trade, particularly when you get into Cold War style economics. It brings a different strategic view to what your assets need to be. And I think that's a way in which China has moved in an interesting direction. But as to whether or not the US has made a strategic decision to move away from and to support de-dollarisation, which is what the comments that Yelena made tend to support, I think it's a difficult one to get to the bottom of, because on one side, I think conspiracy theorists would say, yeah, that's a great idea. There's a load of things that appeals to for conspiracy theorists in terms of how that boosts gold. And I mean, I like gold, but there's a lot of conspiracy theorists that circle in the gold bull markets. I suppose on the other side of it, I mean, like you say, the US would still have very fresh in their minds, even though it was 70 odd years ago, or no, 80 odd years ago. World War II was an event which built the US manufacturing base amazingly, and then they've given all of that away through globalisation. So it's almost as if de-globalisation is coupled in that way to de-dollarisation in a way that they see as being advantageous. Now, I don't know whether they can ever claim that manufacturing capacity back from China wholly, but the things that they really want to be manufacturing, particularly things which are of strategic importance, arms, tech, are the two big ones really for the US. And I would say that is definitely something at the back of their minds. It's an enormous industry, and they would want to be competitive financially in a hot war, because even if it's just the US and China at the top of that, there's going to be all sorts of other nations which want to involve themselves in some kind of fallout who are going to want to purchase arms. And the US wouldn't want that happening, purchasing from the Chinese. So, there's a lot to it. And I think it's a really interesting way to think about what the next 10, 20 years might look like.
From a Department of Defence point of view, you could almost see a world where the US dollar has huge amount of control and leverage over a system, unless that system becomes too likely to be in conflict, in which case you need that manufacturing capacity. Perhaps we've currently skewed towards that potential where a hot war is a real life possibility, which perhaps it hasn't been for an extended period.
Yeah, well, look, if there was a manufacturing industry in a couple of US ally countries, then perhaps a strong US dollar would make a lot more sense to maintain. But I think, a lot of US allies have fallen foul of globalisation the same way as the US has. Australia's a great example. There's been an awful lot of manufacturing which has gone offshore. So we're purchasers. And, in Australia's case, we feed commodities into that process and then we buy them back as finished goods. And I think that's the part which a country like Australia will struggle with. But the US tends to consume a lot more of their minerals domestically. So we'll look at that.
They export dollars, don't they? When we export commodities and they export dollars, and both of those things have made our manufacturing complex non-competitive.
And if you weaken the dollar far enough, then perhaps it becomes an alternative fossil fuel.
In terms of why countries hold US treasuries historically, they obviously hold it because they've got to buy commodities in US dollars, and if they don't have sufficient USD reserves, then it's kind of hard to buy commodities if their currency moves away from it. We see countries like China not operating like that for the last 10 years, where they've been storing their surplus reserves in actual mines and the actual commodities, effectively taking out the middle part of that process. Could you see more countries choose to store their surplus reserves in the commodities directly, rather than US treasuries in a country that's going to be running deficits of $2 trillion plus before a recession even starts?
Yeah, and that's a huge question, and I think it's a really interesting one to ask, because we're going through a period of time now where so many commodities have become more strategic than they ever have been. And I think that's part of their branding exercise, right? Every big consuming government in the world has branded a certain list of commodities strategic or critical one way or another. And in a lot of cases, that is either because they don't produce enough of it themselves, they're a huge consumer of it themselves, or they're very conscious of the dominance that China has in the market, and they're oriented in a way which is maybe not anti-China but suspicious of. So for China to take that tack, there's a country which is not resource poor but has typically is fairly under-mineralised. If you just take production of things compared to consumption, compared to places like Australia, which are the absolute opposite. So Australia's an enormous producer, China is an enormous net consumer, and the US is different again. So for China, we've seen over the past, I would say 2 decades at the very least, China making more and more moves into places like Africa, which I think probably share some of the US suspicion sentiment, which we've talked about already. And they have their abundant natural resources that China are very interested in. And the way the game works is China installs infrastructure that is treated as a debt, and it's one way or another converted into access to natural resources. And the natural extension of that is to be providing funding for those countries one way or another to use for whatever they want to get access to those. And you can do it via offtake as well. So, I mean, there's a large amount of Australian resources which are sold under contract to China under long-term offtakes. So I think all forms of those would be seen as very, maybe not as secure as a US Treasury, but in a very different form of security. A US Treasury can be frozen, like we spoke about, and if you're engaging in a hot war, that's one of the first things you should expect. A commodity supply can't be frozen because it's still in the ground, but you are going to have to go and get it. And that's really interesting when you think about a country which could be, interested in territorial expansion and other things. Now, the history of China, going back over thousands of years, has tended not to be world domination. It's tended to be quite introspective. And domination, pushing their boundaries out, tends to push out into areas where they previously regard their boundaries to have existed. So I couldn't see it pushing that far, but I think the ability to have a China, etc. axis where they could feel that they won't get frozen out of access to territory and therefore could have very secure access to commodities which are going to be critical to the proliferation of their economy. And what underpins the Chinese economy is the stability and the ongoing longevity and strength of the Communist Party. All of that ties in really well when you think about what the Chinese mentality might be and how far out they look. I mean, I look at about 12 months when I think about long-term planning. The Chinese mentality is much, much longer term than that. So, medium-term planning might be 25 years, that's large oil deposits that you need to have in the back of your mind there.
We've sort of seen with some US car companies now where they've done a similar thing. They might be shoring up their supply chain by buying into a lithium mine. And even the way Indonesia, what they've done with some of the nickel exports, restricting their ability to build the processing capacity next door, or the battery capacity next door. Do you think there's becoming a greater understanding of less about the price of commodities and more about the value that they offer in terms of the value they play in the entire economy and how that could play into the inverse of that being a US Treasury in an economy which is at risk of being debased due to just how many treasuries have got to be sold over the next 5-10 years?
As far as that question pertains to US car companies, I would say there's a game that they could be playing there, which is around, well, let's take Elon Musk as a great example, right? So Elon Musk stands up in front of a conference with a microphone. He says, I'll tell you how to get rich. Go and mine lithium. That's how you'll get rich. And you get 100,000, they're the new white rappers. They go off and make a lot of money off of models which have been proliferated in the past. And they're all mining lithium, right? So all of a sudden there's an oversupply of the new big green mineral, and the price comes down. So its value in use to a car maker is one thing at the moment. It's not tremendously high in terms of the value of the finished product, the car, but it's enough for it, and it is a blockage to rolling out more cars. So it's a definite hurdle step. So I think from a US car manufacturer's perspective, they first of all want to have surety of supply, that they don't have to be purchasing those things from China. Secondly, they would like to see oversupply, so why not engineer that with overinvestment? But third, they would like to see that whole greening of the supply chain can be certificated from one end to the other, and they can sell cars and say, well, there hasn't been any slavery, there hasn't been any non-green fingers involved in producing this car. I think from the Chinese perspective, so Chinese car manufacturers wanting to achieve the same offtake has a completely different realm of probably strategic considerations involved in it. And it swings back much more to that strategic value of commodities in the ground as well, because when commodities sit in the ground, they have the ability to be accessed at any time, subject to permits of course, but if you have enough control over those, then you have the ability to influence the forward pricing of things as well as you bring those things to market. So unlike a US Treasury where you can flood the market and under a strong US dollar, you don't tend to devalue those assets too badly. In a commodity sense, if you're wanting to use them, then you can avoid paying taxes in the place where they're from because you can devalue the value of what you're taking out of the ground. The list goes on. So that's the cartoon version I have in my head of it.
And so in terms of gold specifically, one of the challenges, human beings are predisposed to love stories. As they say, what's the most powerful thing in the world? And it's stories, and you can see that with religion and all sorts of things in the world. Gold is such an attractive story to engage with because you feel smart when you're talking about it. You can talk about the problems with the balance of payments price in the US or whatever. How do you manage that psychologically between trading gold in an investable time frame versus that psychological disposition of trying to be right?
Yeah, gold's a good one because it's shiny. You can pull out a nugget and you can get someone excited about a project, and that partially pertains to the commodity and partially pertains just to what it is. I mean, one of the things that worries me a little bit about gold in the quite long term is for thousands, tens of thousands of years, human beings have bonded together in larger and larger groups on the basis of stories which generate shared belief. Well, this isn't my original idea. There's a book called Sapiens, which you have a read of that. It's a great read, and it goes into that as something which separated perhaps Homo sapiens from Neanderthals. If they had an inability to have an imagination and share stories, then they didn't band together in big groups and form community, and that was the difference. Only a theory, but that pertains to gold. Now, for the first time in the history of humanity, there has been technology which can now make up stories, AI, and that can change the rhetoric around how stories and beliefs and all those patterns play out. And when that intersects an economy, I think prices could go wild. Now, would that push gold in one direction or the other? I'm not sure, but you're right. For a long, long time, gold has been an extremely strategic thing. It doesn't tarnish. It predisposes itself well to be currency-like, and for a long time, it backed currencies. All those fundamentals still count. But we enter a paradigm here where that could start to struggle. Now, I think that could be weaponised in the same sense as you're talking, because that sits above the ground. There's always conspiracy theories about where the most of it sits above the ground, but we do know that the China, Russia, etc. axis have been big purchasers of gold in recent years, and that smacks of a move away from US treasuries and de-dollarisation, all those things as well. Did I answer your question? Or
yeah,
I just ran?
You did. And where do you think potentially people get it wrong when analysing actions that should cause a response in the gold price? Do they need to look at inflation in a more nuanced form and split it up between into supply growth versus supply-side inflation? What are some of the things that you look for and go, this should really move the gold price? And how forward-looking do you think it is? Do you think it's looking forward 6 months, 12 months, 18 months?
Well, I think the gold price has moved in the last 8 months. So if you just mathematically back calculate how long has inflation pre-existed, that was probably a 6 to 8 month difference. So maybe gold was only prepared to be forward-looking once the future had really set in. So sometimes I wonder, is it forward-looking at all? I think it responds to crises under those circumstances far better. But the largest macro setting that provokes a response in gold is low to negative real interest rates. So when you're in that environment, as we are now, gold is set up to perform. But that doesn't mean that gold will perform to a certain multiple. Gold will perform strongly when there are a lot of buyers around, and that can either be because lots of people want to buy it individually. But if I look back at the last great gold market, which started in about 98, 99, and it performed almost 10 times through till 2011, the biggest buyers in the gold market at that time was not necessarily the central banks. The biggest new buyer was the gold industry, which had sold forward so much of its own production that it had to buy back more than 12 months worth of production over that circa 10-12 year period, buying out their hedges, which were well out of the money. So they went from suppressing the price, perhaps by hedging, to unsuppressing the price by having to buy all that back. I think that led to some very big swings. So if you're looking at the gold price now and saying, well, could that go 2x, 3x, 10x? I'd be towards the lower end because I don't see that big buyer block coming in at the moment, unless nationalities could replace that buyer block. But look, I think we would have seen that. They're quite careful buyers of gold. So from an analytical point of view, perform, yes. Outperform by such a large margin, hard to see.
And I'll get you to finish off on one answer to a little bit of an outlier question. There's been 2 times in history where the Dow to gold ratio has been 1 to 1. Will we ever see it again?
I don't think you could outline. I don't think you could rule that out at all. Never say never. Some of the times where we've seen that has been when gold has been particularly strong and equities have been particularly weak. Now, we're at a time now where equities are amazingly strong and we're seeing inflation. What unpicks equities? inflation. So if anything's going to bring that about, I think it would be that. So if we were going to see it in the next 20 years, I would say it would have to be within the next 5.
Hedley, Widdup, thanks very much for your time.
Thank you, Chris Judd, for your time.